So we often say that cash is king, but what happens when it goes down? Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk. Dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour, Mike Leroux here. You're listening to the Dividend Guy podcast. So after recording an episode about TELUS and its cash flow, today we're going deeper into that route, right, Véronique?
Yes, because cash flow is not part of our first set of filters at Dividend Stock, but it remains an important trend to consider in our stock analysis. So today we'll use 6 stocks besides TELUS with dangerous free cash flow trends to help investors analyze this metric and identify red flags.
Yeah, so don't just run right now after listening to this one and sell those stocks. The point here today is to add the context around the cash flow metrics, that they're not that obvious. And then sometimes you say, well, but the cash flow is going down, so I'm selling. And I'm like, yeah, well, you need to know there's a little bit more to the story. So some companies are in deep trouble, some others, not so much.
So first, Mike, why is free cash flow not part of your first set of filters, or should I say the dividend rockstar list?
Well, I get this question a lot, where you could have like cash flow per share or free cash flow per share, which could be quite interesting and a good replacement for the earnings per share. Because as we know, the earnings is calculated with counting principles. So it could include stuff like amortization or impairment charges, which has no impact on cash flow. Therefore, absolutely no impact on the ability on the company to pay a dividend. And yet we focus on that instead of going for free cash flow. But the problem with free cash flow is it's incredibly volatile. So it's tricky to use the free cash flow per share metric, as it doesn't count most investments. So when a company is investing in massive projects and they have a high capex, they will often use some debt to finance it. But in the free cash flow, you don't see that. So in other words, you'll have the impression that the company is bleeding cash flow, and technically it's kind of true. So you have a negative free cash flow because the company cannot afford to invest in its projects, and on top of that pay a dividend. But the reality is the debt is being used not to fund the dividend, but rather to fund the projects. So instead, for a business that has a long capex plan of like 20 billions over the next 5 years, instead of like cutting their dividend down to zero and use all their capital allocation towards that project, they prefer to use external financing, where they can use leverage instead and keep shareholders happy. So for that reason, I would say it's not part of my first layer, but rather my second layer of analysis. When I do a screener, I don't want to limit the number of stocks too much. And the more metrics you add to a stock filter, the narrower you get, but also the more you discard great companies that did not have the chance to tell you the story, why they have a negative cash flow or a high payout ratio or any other metrics that you could include in the first layer.
So listeners, I would invite you to put your analysis method to the test, download the Dividend Rockstar list, and while our first set of filters has been applied to that list, you can still use it to learn and dig deeper without getting lost in thousands of possibilities, right, Mike?
Yeah, so the way I use the DSR Rockstar list is I use it as I mentioned, as my first layer of analysis. So quickly, I just focus on companies that are thriving. So revenues are going up, earnings is going up, and then the dividend is going up. So I'm already a happy investor. Then I will enter into the second layer of analysis, which include cash flow metrics, which we're going to talk about today, mostly cash flow from operation and free cash flow. And most of the time when we talk about that, we have to talk about CapEx, so capital expenditure, because it's like the money you generate versus the money that you spend. I'm going to add debt ratio or the long-term debt trend as well in this. I love to look at that graph. Payout ratios for dividend payers, of course. And then will come the third layer of metrics, which includes mostly like valuation metrics. So the average yield over the past 5 years versus the current one. Same thing with the PE ratio, 5-year average versus current and forward, Chowder score, and other kind of metrics that are not enough for me to pull the trigger on the buy or on the sell decision, but more like a complement of the rest of the analysis.
All right, so do hit pause and thedividendguyblog.com/rockstar to download this list now. So, Mike, in general, what's a good free cash flow trend?
To have a trend, it's better to look at the 12-month trailing, so TTM metric. So instead of like going one quarter to another, because in a specific quarter, if you have like a one single event that requires you cash flow, you can go negative and it's totally normal. Or you have like businesses that are quite cyclical. So for like the first half of the year, they're going to be negative. The second half, they're going to be positive. Actually, it's kind of ironic, but if I make the comparison with DSR, there's not much going on during summertime. So we don't run campaigns. We enjoy our summer vacation as well. So those are pretty slow months in the business. So if someone would analyze June, July, and August in my business, they would say, oh my God, this guy's losing money because I'm literally burning cash because I'm not getting much subscriptions, but I'm still having the same operational expenses. However, if you look at the month of January or the month of September, which are like great months to run campaigns because it's kind of like either like the back to school or the start of the new year, kind of like a gym type of business. Well, those months or those quarters are a lot stronger, but it would be also a mistake to just look at like the first 3 months of the year and thinking that my cash flow is going to grow like this for the rest of the 9 months, because it's not going to happen. I'm going to be very disappointed back in June and July where everyone is on vacation. Nobody cares about investing. So this is why it's important to look at 12-month trailing. Of course, you want something that goes up, but when you see that there's a dip, it's not necessarily something bad. It just put out the red flag and tells you, hey, you need to know what's going on there. So it's a good way to understand the business a little bit more because it tells you where to dig to find real answers about when the business is going well and when the business is not doing so well.
Okay, now what's the difference between free cash flow and cash flow from operation?
Put it simply, the cash flow from operation or operating cash flow could be seen as like the raw power. This is the money that you're making with core business activities. It tells you if the company is making more and more cash flow from operation, that means that it's going well because they're selling stuff minus the cost of their operation and there's a lot of money still there. The free cash flow is what's left. That is like the kind of like the purest thing of cash flow because you have the cash flow from operation and then you deduct all capital expenditure. So of course, when you have a company, and this is what we're going to go into today, when you have a company with a large capex plan, well, then the free cash flow is going to be negative or very weak. So you have to be careful to not judge too quickly when you look at free cash flow. So in an ideal world, you like to have positive and growing free cash flow. But if the business is investing in its future, it might not be a bad thing to see negative free cash flow for a while, as long as you can justify it and there's a solid plan behind the whole strategy.
Okay, so let's now use real examples, starting with a very well-known one, Pepsi. When I looked at the chart, the overall trend is down for like a decade, but there were years when it went up, Mike. So what's going on?
So first things first, I mean, company like Pepsi has a capex of about 5 to 5.5 billion per year. So already they're spending a lot of money. So if they have a bad year in terms of revenue, free cash flow is going to be affected quickly. They also had to invest a lot right now into the improving their productivity. So automation, digitalization, making sure that like the warehouse are like highly automated. So that requires a lot of investment, but it's in the promise of generating better margin in the future. And here's why I say is, do you believe that Pepsi is able to invest that money and then eventually become more profitable because they become more efficient? And that's always a thin line where you kind of have to guess at one point. So you're going to know a little bit more with the history of the business, their expertise, if they have been known to be good with their capital allocation and making the right decision to become more productive. This is the type of things that you want to look at. They also had a final payment of $1 billion in tax related to the Tax Cuts and Jobs Act of 2017. So now they're going past that. So moving forward, management, you're going to love that. Management expects better cash flow moving forward. So we should see the trend coming back on the upside, making us smile. But of course, when you look at the dividend triangle, we saw kind of like a slowdown as well in revenue and earnings. So I'm not really surprised that the cash flow is taking a beating right now. But what I like is when management tells us, yeah, we had a rough patch. Now we're moving towards something a little bit better.
Okay, so exchange income is another one showing a down free cash flow trend since 2021. How would you explain this?
This one is quite interesting because the dividend triangle is strong. So revenue and earnings is going up. The stock price has gone up on a tear for the past like 12 months or so. It's a small cap, so always be careful with that. But what's going on here? Well, the thing is the cash flow, and also forgot to say, the cash flow from operation is also rising. So a lot of metrics are pointing to the top, yet free cash flow is down. So then, as I said earlier, it's a great way to say, hey, there's something going on here. I need to get more context. And it's a great red flag that will push you to dig a little bit further. And then you're going to realize they are growing by acquisitions and they're making a lot of acquisitions. So, of course, they will finance those acquisitions with more debt. So, you'll see the relationship where long term debt is increasing and then it requires a lot of cash flow to make those acquisitions. So, that's the first thing. The second thing is they are also building new manufacturing part. It's an industrial business. So, half of the business roughly in the aviation. So, they're servicing northern Canada. So they need to reinvest in their fleet to maintain like a high quality fleet of airplanes. And on the other side, they are also quite active on the industrial manufacturing parts. So again, investing in more productivity, in new plants to be able to produce more at a lower cost moving forward. So when you consider all that capex, totally makes sense because everything is made to either grow the business through acquisition or become more efficient and therefore improve the profit going down the road. So it's a temporary problem of cash flow that is covered by higher debts. Of course, now moving forward, and even management started to do that. Now they're just like, yeah, we have turned this corner and now we want to pay down aggressively debt because again, for a smaller company, having a lot of debt could lead to a lot of problems. So I kind of like how the company is able to manage its balance sheet with sound moves instead of like going crazy all the time. And one thing that I found very interesting on this one is they were able to maintain their dividend payment during COVID while everything was closed for them. So of course, no airplane transportation and or very, very limited. And many industries, manufacturing plants that were closed or temporary closed or working like at 25% capacity. So, and they were still able to maintain their dividend. A pretty good deal here.
And a Dividend Stocks Rock member asked you about Mondelez in our most recent DSR webinar. So I thought it was an interesting one. Is it a real problem for Mondelez?
They do face some important challenges right now. And when you look at the dividend triangle for a second, it's kind of interesting because the revenues are increasing, not earnings per share. And as you mentioned, not cash flow as well. So what's going on? Well, cocoa price. I mean, it keeps going up. And of course, when you're selling chocolate bars and chocolate snacks, it's kind of hard to find a replacement. I mean,
Right.
I'm sure that they're like the first business that would be thrilled to create their own, I don't know, synthetic chocolate that could be healthier with less calories, even and having the same taste. But in the meantime, it hurts their margin like big time. And this is an ongoing problem. So you see the difference between, oh, we could say Mondelez right now is also investing in a new ERP system. It's investing in a supply chain reinvest to modernize it and make sure that it's automated. So there's more profit. So it's more a seductive way to explain why cash flow is going down. The real problem here is definitely inflation related to the cocoa price. And I don't see how they're going to manage through that. So their margins are going to get squeezed and it's going to be an ongoing problem moving forward. That is one of the big reasons why the stock price is not going up right now.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. You know, our goal is to help more investors just like you, so please spread the love. Thank you. All right. So another one worth discussing is a tech stock, Texas Instruments, which you used to like, right? And it has seen a significant drop in free cash flow since 2023. So why is it so, Mike?
I mean, to be fair, I still like it, but I did sell my share a few years ago. The reason
Mhm.
why I sell was actually there was a big discrepancy between the dividend triangle and the stock price, meaning that the revenue and the earnings metrics were going down and actually cash flow as well. But the stock price kept on going up. And at one point, I was like, I'm overweighted in technology stocks. And on top of that, this one doesn't make any sense because the price goes up and the important financial metrics for me are all going down. So I just sold a pretty nice profit, super happy with it. I mean, it's a great tech stock. I mean, they're building analog chips. They are used in different industries, mostly industrial clients, automotives. So very interesting and stable business. But the free cash flow in a historically high of 6 billion and went all the way down to 1.5 in 2024. Now
Hmm.
it's slightly going back up to 2.9 in 2025. So we still like see some lights at the end of the tunnel. And one thing that explained that was because they are in the middle of a 6-year, 30 billion investment plan. So when you're investing that much money in fabrication plants, those fabs in Texas and Utah, well, of course, it requires some cash flow, right? So you might
Mhm.
be a cash flow making machine. That's just too much money to be invested right away. And the other interesting play that they did is they intentionally grew their inventory of chips to be until late 2025. So they wanted to make sure that they are ready to sell those chips because, the semiconductor industry, depending on the type of semiconductors you're making, like your clients are going to go through investment cycle. So
Mhm.
in a down cycle, sometimes a company like Texas Instrument will decide to grow up their inventory to have like a lot of chips because they know that eventually they will be like almost sold out because everyone will wants to buy chips at the same time, which is what we have seen last year, for example, with Nvidia selling AI chips. So they did
Mhm.
not want to get into that trouble, but as you grow your inventory, that means that you're spending money to produce those analog chips, but you're not selling them. So of course your cash flow is not going to the right direction. It's kind of like a smart move if it makes sense and there's a high demand for chips down the road, so they'll be able to sell it at a better margin. But it's kind of like a tricky game because they could be sitting in a warehouse way too long and become obsolete as well. So we'll have to see how it goes. I mean, Texas Instruments is a well-managed company, so my guess would be they're making a right move, but you'll never know until this unfolds.
Okay, so moving on to another well known brand, Nike. Looking at its chart, we can see big ups and downs every 2, 3 years, but it is down since 2024. Is this a real problem and how should we look at it?
Well, Nike is facing a lot of headwinds, as you may know. I mean, tariffs have been one big headwind for Nike and especially for its margin. They assumed that last year it cost $1.5 billion more to produce their shoes. They also ran into a major strategic mistake a few years ago. They tried to cut out partners like all the retailers in the wholesale, like Foot Lockers, for example, and they wanted to go direct to consumer, the DTC segment that you see when you look at their financial statement. And the problem is they wanted to do this because they thought, well, wholesale are going to sell our shoes at a smaller margin because there's an intermediary here and we could sell directly to the consumer and making a lot more money. But they kind of like underestimated the network of those retailers and that power. So now they're pivoting back, trying to gain the favors again. But I mean, of course, if you're getting cut out by Nike and then you have like Pumas or you have like Adidas, well, you might just sell their shoes and there you go. You're just gonna say, you know what, Nike, just go at the end of the store. And yes, you're gonna have some room, but maybe you're not gonna have that premium location that you used to have. It's all about now getting back on track. I mean, they have this whole comeback plan with the new CEO, Elliot Hill, and they voluntarily spend a lot of money. They are investing in brand marketing. They are giving rebates on their inventory to and deep discount to get rid of older shoes to come with like more new brands and new shoes coming up. They invest in their supply chain. So they are in a very crunch time where I think they're going to turn that corner and become a stronger company, but that's just my opinion and I could be completely wrong, but this is
Mhm.
what they're trying to do. So if they make it happen, all that bad cash flow metrics going down is being directed to this plan. So if the plan plan works, it's going to be amazing. If it doesn't, well, then the stock price is going to continue to go down. But it's definitely a rough timing for investors, testing their patience, testing their ability to trust the process and
Mhm.
trust the management in place. And unfortunately, this is the part that is the most frustrating, because you could listen to 10 experts about Nike, you're going to have 10 different outcome. Everyone
Right.
has their perception of their plan and how it's going to unfold and if it's going to be successful or not. And the real answer here is we don't know. We don't have a clue. I mean, if we had known, I mean, I would have remortgaged my house and buy a bunch of Nike, because right now it's definitely trading at a weak price, but maybe it's just priced to the problem that they're in. So you'll have to
Mm.
figure it out down the road.
All right, I will need to check that one back in a few quarters, I guess. So, all right, actually, we're going to end with this one: air products and chemicals. Its free cash flow trend looks dangerous to me because it's been declining since 2022. It is also combined with a slower dividend growth. So, Mike, what's the problem here?
Oh, this company is fascinating. I kind of liked it at a point several years ago because, I mean, they are supplying industrial gases. And what is great about that, you're thinking about like hydrogen, you're thinking about like a bunch of like small gases that are critical for businesses, but they're not a big part of their cost of operation. So they kind of like get those contracts, they use the gases, ADP selling those gases, everybody's happy, and then of the story. So great business model, had like long-term contract, sticky business, great dividend triangle back then. And then the first thing that I really didn't like before cash flow, and it was around 2022, but the CEO back then said, oh, we are going to pay a dividend and manage our dividend growth rate based on the current stock price yield. And I'm like, well, if the price goes up or goes down, it cannot just influence your capital allocation like this. That doesn't make any
Mhm.
sense. So that was a really weird comment. And that was like the first small dividend increase that was followed by like other smaller increases going forward. But that was also linked to the need of capital elsewhere. So at this point right now, we are looking at a business that is massively investing to pivot towards hydrogen, the production of hydrogens, and then to make it like as green as possible on top of that. But that means they must invest a lot of money. They have a capex plan of 15 billions throughout 2027. They lean heavily on debt to achieve that. So you have again this dynamic of, oh, we do have a plan, we have expensive projects, and we're going to generate more cash flow down the road. For this one, I mean, I don't have it in my portfolio. I bought it and then sold it a while
Mhm.
ago after I saw that the management was just like, yeah, we don't really have a real capital allocation strategy for the dividend increases. We're just going to go play it by fluke with the stock price and look at the yield. I don't like what management improvised, and that was clearly a sign of improvisation in my mind. So I got rid of it. At this point, I find that there's a lot of debt. And of course, as you mentioned, cash flow is not there yet. So hopefully they have like some projects that are almost complete. So hopefully it's going to shift the narrative and create more cash flow down the road. But at this point, I'm not too interested.
Okay, so looking at the stocks that we discussed today, which ones would you buy more and which ones would you sell?
Well, I do have a small position in exchange income that is part of my Smith Manager. I actually regret of not buying more because this one is actually doing pretty well, but that's part of the game. So definitely an interesting one. Again, keep in mind, it's a small business. It's highly volatile, so proceed with caution. The other two that I find quite interesting though, because of their brand, because of their history, and I don't think that people are going to stop drinking soft drinks and eating chips and buying Nike. So Pepsi, Cola, and Nike are the most interesting ones in my opinion at this point. They're trading also on price weakness right now, so it usually leaves the door open for a good opportunity. But again, you have to be patient and you have to do further research before jumping on either one of them.
Mike, to end this episode, please give us a quick guide to spot red flags related to cash flow.
So, as I said at the beginning, it's quite volatile from one quarter to another. So, it's best to focus on 12-month trailing numbers because free cash flow could mislead you oftentimes. What is important is to understand the context, the story. What's the plan? Why does the cash flow flow is declining. It's a lot more alarming when you have cash flow declining like Mondelez because their margins are getting squeezed because they're dependent on the cost of cocoa and there's not much plan B here than when you look at a business like Texas Instrument that is trying to make a move by increasing their inventory and investing massively into the fabrication of new chip plants, which could technically lead to more revenue and more profit down the road. So understanding the story, understanding what means, and also looking at the history, like management, are they known to use capital the right way or not? So yes, it will require you additional digging, but if you don't do it, you're kind of like walking blindly into that investment. And I would not do that. So dig into financials. You can actually ask AI with specific questions. And what I would suggest you to do if you're using like Gemini or ChatGPT, for example, is go on the company's website, download the quarterly or the annual statement, upload it into your favorite language model, and then start asking questions and ask it based on the analysis of that PDF only. So you will limit the number of hallucination or false information or interpretation that AI can do. And when you're not sure, you can ask it, well, can you tell me where you got that number on which page of the PDF? So then you can double check the information as well. Because you cannot just go blindly once again and just say, hey, ChatGPT, what do you think about Pepsi?
Right.
I mean, it's a little bit too easy. And yes, it's literally like asking a junior to do the research for you without giving them boundaries and rules. And finally, the combination of the dividend triangle with the free cash flow chart is going to tell you a lot more about what's going on. And it's going to be easier to figure out, is the business still thriving or not, even though the cash flow is declining. So we're fortunate at DSR because we do have the cash flow from operation and the free cash flow graph for 10 years on top of having the dividend triangle. So matching more than one financial metrics and adding context to it is always the key to make the right investment decision.
Well, thank you so much, Mike, for this amazing guidance on cash flow. Listeners, remember to download your Dividend Rockstar list for free to get ideas and also to put your analysis methodology to the test by entering your name and email at thedividendguyblog.com/rockstar. If you like what we do, let us know by hitting pause and the subscribe button underneath our podcast logo. And until next week, stay invested.
Stay invested. Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk, dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time.